Well, I think we can all agree it doesn't get bigger than this for traders, investors, and of course, scalpers in the market. Not only are we hitting new highs for the year, but we've also got trillions of dollars at stake. Yes, it's that time again. Quadruple witching, OPEX, and more importantly, the Federal Reserve. It's CPI week, which means inflation numbers are coming, and we may even see a 25 basis point rate hike. If some of these things, even just some, occur, we're going to see volatility like you haven't seen in a little while. And on top of that, volumes are going to be up. So what have we got in store for you today? Well, we'll be breaking down stocks, commodities, and cryptos in more detail to really show you how each one of these could be working this week. We've also got some of the latest central bank inflows and, of course, big money manager moves. Let's get into it. Well, welcome back, everybody, to the Daily Show where we talk about markets around the world. We've got the latest news, the macro data, the lead indicators, and of course, the hottest charts coming your way. If it's your first time here, subscribe and smash that like button. You're going to find value in today's video. We have so many good things to discuss. So first up, we all are aware of this, I'd hope, and that is that the S&P 500 has entered a new technical bull market. Now, what does that help us with? Well, not that much is the answer, except that we can pull some stats and data around that. So, of course, will we be doing it? Yes, we've got the latest 1 to 2 weeks, what happens, 3 to 12 months, what happens there. Let's go through some other big news though. And of course, yes, we cannot not talk about crypto. It's down on the weekend and it could be beginning to make us think, well, maybe the stock market also may follow with a little bit of volatility. Remember, crypto has been leading a little bit here in some cases when it comes to these points. Now, we already know the SEC is all over this. And of course, regulation could be coming to the crypto market. But there has been some big rotations occurring over the last couple of days. Bitcoin is now becoming the predominant leader, and realistically, again, all of the alts are selling off. Things like Sol, Matic, Doge, ADA suffering double-digit losses, and it's one of those times where it may be best in the crypto market to potentially bunker in because big players, such as this one here, are selling huge portions. $2 billion of literal coins just sold off straight away. If we take a look at market dominance, you can see here on this chart that Bitcoin is still actually holding up relatively well compared to the rest. And of the $1 trillion, it's pretty much not been this large in discrepancy to the alts for quite some time. It could also mean bad things are about to happen to the rest of the market. This is the type of rotation that we tend to see. So we mentioned before trillions of dollars are at stake. This is a great chart here that shows the S&P and 4 quarterly options expirations. These are the big ones, what we call quadruple options week, or basically the quad witching. Now that means that all of the big options are expiring, the stock single futures, etc. We'll do that later on this week if you're not aware of what it is, so you'll get an idea of that one. But generally the Thursday before the options expiration of Friday becomes a very volatile event. Take a look at the pre-week and post-week though for June's, and you'll notice here that sometimes we get, I guess a little bit of positivity, but look at the last 2 years, both negative actually leading into this particular pre-week OPEX. Very interesting. Then the week after has been positive. It's done a bit of a switch. What you may notice though is that they are not incredibly positive times. In fact, the posts have been pretty horrible for both the June and the September. Take a look at this September. Only 7 up, 23 down. Wow. For a stock market that is generally bullish, that is an incredible stat. We know that T-bill issuance is starting up, and we've got, of course, the auction dates here, some big auctions. It's not anything to joke about, 65 billion, 58 billion, several big T-bills coming in this week. And of course, we know that there are even more coming throughout the rest of the year. Am I worried about it? Probably not, but there are some complex forces at work, and we will have to watch some numbers this week, which I'll cover here on the channel as they come up, if they start to show something worrying that we need to pay attention to. S&P 500 call options, they hit $700 billion. That is from Goldman Sachs. It's one of the biggest, it's the biggest read we've ever seen in calls. And I shared over here on our Twitter, follow at FX Evolution, links in the description down below, a really interesting chart that shows you the difference between the current tech stocks and also the inflows. Now, inflows are massive. Now, why? Because mutual funds missed out on a lot of these big tech stocks and they were forced to buy in to get their percentages that they need to hold. But on the top one, I think it's more interesting to look at these call levels. take a look at some of these points. And if you go back to the charts, you might be pretty well aware. Have a look at September of 2020. Take a look at February of 2021, February of this year, and of course, the most notable one, November, December of 2021. We all know what happened straight after those. 1 to 2 weeks, 1 month later, it wasn't usually too long, and we saw relatively significant sell-offs. You cannot ignore the power of greed, and of course, the markets know how to suck it in, and they're doing it at a good rate right now. This is the most cautious we've really had to have been throughout 2023. The next 1 to 2 weeks, maybe even the next month, is going to be a very interesting time for both bulls and bears to see whether this market can get supported. And I would think that individual stocks and sectors are still the best place to be over indices, unless potentially you are a bear. But even then, we haven't even seen the technical turn signs yet. Now, why could we may not have seen the technical turn signs yet? Well, it has a lot to do with this, actually. This is S&P 500 structure, volume structure, basically. And you can see that hedges aren't really around on the 12th and the 13th, which, of course, Monday and Tuesday. But then the most hedged event of 2023 is coming through, which is, of course, the Federal Reserve. And basically what we're seeing is the interest rate decisions and all of those big things going into this week's OPEX are very well hedged. It's unlikely the market can get absolutely destroyed because these hedges would have to get paid out. And when you've got the most hedged event, that's going to be a problem. But after this event, we see significant drop off of the structure. So this is something we'll have to keep up to date with. And of course, I'll be covering it here on the channel. But it does bring up an interesting idea about even max pain this week. The first and only week we usually use it in a month is OPEX, and we're going to have to talk about it later on. Fear and greed index, what's going on here? Extreme greed. Well, I don't think there's any surprise there. Where we are, the current euphoria, everybody feeling so great about the markets. Hey, it's great if you've been in the right stocks. Congratulations. And if you've been in the wrong ones, well, it's been just kind of like a lot of sideways, hasn't it? But let's go have a look at what the biggest players are doing. First up, we've got leveraged money. They're shorting massive, and I mean big. So this is one of the biggest short reads, and depending on who you talk to, it can be one of the biggest reads of the last 14 years. Now, they've shorted like this a few times where it's been heavy shorting, and they've generally been correct around 1 to 2 weeks later. Basically, back here in August, we got a read, and that read ended up being correct. They deleveraged their shorts. Now, are they always getting it correct? They tried to short 2020 and they instantly took that off. Now, they took that off in the September pullback. So did they still get a pullback in the markets? Yes. Did they lose a little bit? Yes. Are they generally correct? Well, it turns out yes, but of course, it's only when it gets to these extremes. So August, there's March, and of course, we are here right now in June, and we're seeing a huge amount of hedging. Now, if we have a look at gold, which I thought I would bring up as well, we saw a small uptick in purchases here for gold over the last week. Now, that's not enough to be significant. These are the types of ones with price action that usually show us that we've got, a nice month ahead of us for gold. But it's a little uptick, and it probably shows a stabilization of price. So whether we're in a distribution or an accumulation event, still to be determined. This week's going to be volatile, I would say, for gold, dollar, etc. But we did see a small uptick, which is why it's being supported at these prices. So I promised you I'd talk about performances after we exit a bear market. And it kind of leans into what we're talking about right now, which is that there are too many calls in the markets, that we're starting to get to these extreme levels, extreme level number 2, and everyone is going crazy. Now, I totally get it. At these points, it seems like if you've been on the sidelines, you just rage. And if you're in there, you're getting euphoric, and it's very hard to bring yourself back down. But these are the cold, hard stats. When we've exited a bear market in terms of any time, 1 week, 2 weeks, and 3 weeks later, markets tend to be actually statistically down. Now, are they statistically bullish over the next 1 year? Yes. Okay, that's what happens. 61.54% of the time they are bullish. But let's take a look here at the overall stats. You can see some of the years, and it's not like that hasn't happened generally. Now, I would probably ignore 2020 because we all know that that was a Fed injection. We haven't really seen the Fed injecting recently. They've been stabilized with their central bank liquidity because of the treasuries, but that could be about to change. I'll update you guys on the Monday video with some thoughts of Druckenmiller recently and my thoughts on top of that of what we're about to potentially see. But if you take a look here, 1, 2, 3 weeks later, you can see there's some significant pullbacks that have occurred in previous times after, remember, this is after exiting a technical bear market. So some interesting stats there. Let's have a look at the futures market. We haven't brought this one up in a while. And what it does is it tracks, or we've tracked here, thanks to a member of the community. Thank you so much. We basically tracked all of the up and coming forward yield curves. So this shows you, and it's we're looking at this line here, by the way, that we're returning back to another previous period, which is February, when markets cracked it. And then we saw a bit of a pullback thanks to, of course, a lot of regional banks having a suffering period. Now, what's occurring here is it doesn't look like there's not much expectation anymore for a rate cut for this year. Now, remember, there was so much expectation of rate cuts. We're about to see the dot plot come out from the Federal Reserve, and that should show us whether the Fed is going to stick to their line, which I suspect they will, of no rate cuts until 2024. I'd be surprised if the market is correct here, and the market is expecting maybe 1 to even 2 rate cuts still in this year, but still higher for longer is going to eventually put some pressure on the markets. This one blew me away when I saw it. I was really surprised so many people voted in this survey towards the bull end, 44.5% bullish. I haven't seen a read like this, as I said, in like 2 years. It is an extremely bullish read coming off a pretty neutralized read, if not a bearish read. Yeah, there's something in the air, guys. Everyone is losing it. And I'm sure many of the people out there are just looking at this saying, are you insane? Like, you should be getting on board. This is the time exactly when I don't get on board. That's actually what we were looking for. 44.5% though is a huge read, 31.2% neutrality, and 24.3%. I do usually like to get 2 weeks of this to make sure it's not some weird outlier, but I can tell you it is one of the 7 style reasons that I use to actually tell us that maybe a market is topping, and that we then, this is a swing top, by the way, not just a scalp or day trade top. I'm talking swing top. And why would that occur? Because everyone's getting suckered in. Now, that doesn't mean that you are suckered for making 30, 40% on Tesla. You just have to know when to hold them and when to potentially dump them. And we've talked about how 0DTEs took over on that stock about 2 weeks ago, and it's been ballistic since that point. Let's have a look from an investor standpoint. What do you do? Well, of course, you can make your own decisions on investing, but we are still above the average of 16.8. We're probably trading about 18.2 forward PE this is at the time of recording. And I do prefer to buy it in the 15s, 15 and a halves, and maybe even a standard deviation away if you can ever get it. That's the type of thing where, you get your deep value investing. It doesn't mean you have to buy crappy stocks. It just means you're buying quality stocks at a pretty good price, at least based on historical averages. Where are we? We're in June. We know that technically in post or pre-election years, we usually see a little bit more run in the market. This is entirely still possible, though we are seeing many signs for it to start, kind of topping a little bit here. You can see that we generally get a little bit more of a run. Some people believe Q3 is the bad time. I tend to agree. Q3 is historically the worst time for markets, but we're getting some weird signs here in June. Let's have a look at Exhibit A. We'll go into the charts. Very far away from mean reversion for the biggest stocks that have run this market. These are the Microsofts, the Apples, the Nvidias. I've made my own chart here so you can see the power of those this year and how much they've really run this market. We're super extended away from mean reversion. You can see how important mean reversion is in these markets, and it actually hasn't happened since January. We actually have not come back to the mean on the 20. This is something that's kind of unusual, and even during the greatest bull runs that you get, you will eventually get mean reversion. Remember I talked about August, September before with the calls? Well, you can see these are significant sell-offs. This particular stocks selection dropped 20% over that time. Am I saying it drops that much? Well, if it's a brutal sell, then we probably should be looking at about 16% down to the mean reversion. So certainly some of these stocks are a little bit too extended away. Let's move over to some other selections here. This is NASDAQ versus Russell. Russell struggling at that most anticipated kind of most traded zone. not unexpected there. And we saw the NASDAQ versus the Russell still close on a bearish position. So rotation's still coming in through those markets. The skew, one of the things we've used recently, we saw skew crush, very good for bears. Skew ignition, not so good for bears, and a little bit of a crush. I want to see skew getting destroyed. We want skew going down while the market is sideways, prepping for a potential swing turn. Ideally, skew gets crushed again. Not that great, that chart, as much as I would like to see it the way it is. The first crush, though, was spectacular. We expect the bounce, but that bounce was a little bit too much. So it could still show a little bit more froth is in this market. We have to wait for more skew crush, ideally. PCC is showing all the right signs, but usually this turns back up before markets will sell. We've had this plenty of other periods. We've had this, of course, in February. We had this in November. You go through all the periods and you'll see when puts are this low, generally it means that people are getting a little euphoric. We'll continue here. The volatility of the volatility is bouncing up. That usually means something weird's about to happen. And of course, we have the VIX hedges coming off this week in OPEX. So as of this Friday, or this Thursday really, I think it is, then we'll get the VIX options coming off, and basically that may enable volatility to come back into the markets. There's too many calls on these positions and they're getting blocked. And it's a bit different to zero DTEs, and we'll explain that one other day. That's a story for another day. But basically the VIX is sitting here back below the 2020 basically lows before that whole thing got very volatile. It doesn't mean it's going to go 2020 style, but certainly these are the signs you usually see. It's like the calm before the storm. What about the percentage of stocks above the 200-day moving average? That's not too bad. Rotation is certainly occurring, and if you've been following this channel for a while, especially the last 2-3 weeks, you would have noticed that the rotation stocks have done better than maybe the fan favorites out there. Though, of course, NVIDIA, up until after the earnings, was the absolute spectacular one. Let's have a look at central bank liquidity versus the S&P, etc. Central bank liquidity in general around the world is low, the purple line. The Fed, the green line here, is doing okay. And what this is doing is it's still showing us that we're too far away, too extended away from where the liquidity is. If you believe that the central bankers are running this market, which they kind of are, then both the Qs and the S&P are too red. And we've seen similar times of this. August, we saw it in March, we saw it in, of course, 21, and we've seen it plenty of other times. Another one that was notable was that February. And of course, you know what the other one was notable of was September. And I think we all know what happened in each one of those markets. I'm not saying it's an absolute guarantee. It just shows you how rotation can occur when you least expect it. At least you've got to have your spidey sensors on, at the moment in markets. Dollar index versus the S&P 500. What the hell is going on here? It's strange. The dollar's been going up. Obviously, we called a weakness in the dollar last week, and it has been weakness, but the market's been going up too. Have we disconnected from that reality over time? That was something that was a big story in 2022. It helped us to figure out things. It's only one reason. At the moment, I don't think it's giving us much edge. Disney, a stock that we talked about, some rotation coming into. It's run a little bit since we've talked about it. Had a mediocrity kind of Friday, 0.65 down. I'd like to see Disney break to the new high and then continue to rally up. This is a stock that doesn't usually do well in these pre-election years, but it's been sold off already. And of course, we saw that island reversal. And sometimes when the market goes defensive, it will move into these beaten down stocks. Look at Intel if you're interested during February, and you'll see what I mean. Let's move over here to Meta. This stock looks pretty bad in my opinion. You go to the weekly, you're on a 61.8 retracement. The weekly didn't exactly fully engulf or anything, but new lows should bring the swing turn, which is going to be somewhere under around 258. Now, this is probably the stock that I think is one of the worst in the market at the moment of the big tech stocks. I still think Apple will kick their ass. What do you think in the comments down below? Some other ones that I saw some zero DTE action on the Friday was Piton. Proceed with extreme caution on this one, but I did see a few little call sneakies coming in on this particular stock, and you can see it absolutely exploded and then dumped back down. Again, when you start to see some of the sickest stocks in the market having explosions like this, that usually means you're getting to the last rotation of all of that. Another one that we spoke about last week, thanks to viewers out there in the community during our Monday live streams for the pre-market, subscribe and you can watch those as well. They're completely free those Mondays, and we have a great time here on the channel, was SoFi. Probably the best returner, or one of the best returners of the week. I think it was, we were looking at it around here. Where's our Monday? So around here. And we ended up seeing around a 24, almost 25% move for the week. Of course, it ended up about 16-ish%. Congrats if people were in that one. That was certainly in rotation. Is this a sign of turnaround? Well, it's not the best, and it's kind of like in line with PLTR. We're seeing these kind of blow-offs. PLTR, as we expected, is bounced, and then it's sold off from that bounce. I would guess this stock has probably run its course for now, similar to like an AVGO, which I think Broadcom also has run its course, and I would not be very comfortable in going long in these pairs unless it's for scalps or day trades to a very specific level. We'll go over now to utilities. Defensive markets have done okay. However, utilities really still floating around. It was down about 0.58. It held better than some markets, but yeah, not an extreme performance there. We've already talked about the calls that are on this market this week at 4,300. It's going to be very, very hard to get past 4,300 with so many sold covered calls floating on top of it. They're different from the zero DTEs, but let's move over to the roulette markets that have been going on right now. And there have been some big positions occurring. One of the ones I've got my eyes on is actually Target in the future. And I think Target's getting, is obviously having a huge amount of options volatility on it. You can see 3.17 times. I will be looking at that this week. I expect it to fall a little bit more as people keep trying to buy it, but I don't think you should buy the stock until it gets to the right levels. But you can see it's starting to get equal call and put volumes. So there's a lot of people fighting it out who will win that one. There were some other notable large trades going on. We saw Carvana off that massive earnings report. I think it went up like 50% or something, and then dropped 21.3 the next day. We've got Adobe, which has really been absolutely pumping. That's a stock that we looked at on the Monday. Very, very nice. And we've got some underperformance of quite a few stocks here as well on the 90-day average. And look at these ones. It's Meta, it's Amazon, it's Apple. These types of stocks are starting to just slightly underperform. Netflix is doing really well. I tell you, I reckon their switch is really working, which is that forced, pay for extra users. That's going to affect their share price, and investors that pick that up cheap, I think they'll be pretty happy with themselves. But if we have a look through the rest of them, of course, Tesla was the standout. And this is the one where we're going to probably see the biggest trap form. So let's have a look over here. Here's just a quick thing you can pause if you want to see the put-call ratios on all those stocks. Let's get off this and move over to the SPY. Now, SPY is getting a little bit more puts in it. Take a look. Call, put, call, put, call, put. Now, we have not seen that many puts in comparison to calls except one day last week. So if this continues to hold up, take a look at where they are. Some of these puts are actually Monday puts. So they're not Friday puts. They're pushing them out a little bit into the week after. Volume is still significantly towards the calls. You can see this position was just massive, but we're looking for more puts, and I want to see some big long date ones also, or at least 1 to 2 weeks come through. Watch these like a hawk. It's going to be really important. When we go over to Tesla, I think it's also becoming more aware that there are a few puts and calls coming through. So it's not just like a call strike across the board. The biggest trade of the day actually was a put, and I don't blame them for having a go at it, which was obviously trying to short off those 250, 260 highs, and they probably made a little bit of money actually on the session. And then you can see here all of the other positions. So we'll be watching those very closely. Notably, as we scroll down, you'll see some of the old favorites. Somebody entered into a big put in CVNA, and then we got Neo, you got SoFi, you got Netflix. You can see here the stocks that are getting the interest on them. And we'll be watching that a lot this week as we go into the big OPEX. Let's have a look at central bankers. What are they going to do? According to economists, 30% of them are going to expect a 25 basis point rate hike. Fair enough. Well, I would call it 50-50, actually, in my book, based on the other central banks. Let's have a look at rotation. Here's the 1 day. Jets having a good performance over the last couple of sessions. and semiconductors and technology did okay, but that wasn't really the story of the last 5 days. If we go to the last 5 days, you can see here it's a totally different story. It is sectors that have been hated recently. Metals, energy, utilities, consumer discretionary remained one of the stronger periods here. And technology and semis and stuff, they actually were barely up, if not down, over the last 5 days of trade. Something that is very interesting when we consider how they've been running the market in 2023 so far. So just before we jump into the hottest charts that we need to be looking at right now, and there are quite a few of them, I'd like to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, if we check out Tiger Brokers platform recently, we like to look at the rotation that we've just been watching. One of the things that's very noticeable straight away is automobile manufacturers, pretty much Tesla here, has been the one driving the market. And we know that's because of zero DTE options. We've already detailed that in today's video. Will it continue? That's an open question. But when you start to turn over to the last 5 days, it shows a very different story of what's been running these markets. Yes, you've still got the Tesla trade, but things like semiconductors and even technology stocks have really been going behind the times. And it's a full rotation occurring in these markets. Now, if you're looking at things like maybe retail banks or regional banks or even utilities in general, they've been some of the better sectors over the last 5 days. And we always want to be watching this because if we can really see a rotation, we can do incredibly well. Just take a look at this. Something I like to do each week is to load up the 20-day, the 5-day, the year-to-date, and have a look at what's been rotating through the last couple of weeks. Here you can see footwear has been one of the worst sectors to be in recently. If you wanted to know which footwear stocks have been performing the worst, you can click on it, and on the right-hand side, it'll show you all of the ones that are detailed in there. Of course, a lot of you like Crocs, Nike, some of these stocks are quite popular. So there are different markets within markets, and I think that's something that a lot of people need to be looking at. I believe this is going to be the most important style of trading over the next decade due to the possibility of what we call a lost decade or lower index returns than we've usually been seeing. And even right now, picking the individual stock and rotation has been one of the best trades over the last month. Thanks very much, and check out, of course, Tiger Brokers in the links in the description down below. Let's get into the charts right now. All right, well, let's continue through our charts here. We've got plenty to cover. We've still got treasuries here before we get into the indices. Treasuries still finding bases around this 100. I am not absolutely sure whether this is not possible, which is, of course, 87, 86. I'm going to like that price if it happens as an investor anyway. But we've got some key levels here. We've got around 100, just underneath 100 that could happen this week. And then, of course, we've also got that 96. These levels still present, I believe, interesting upside, but I'm not sure if they're going to be trade zones. Let's move over to the other markets. We've got here the US dollar. It sold off our key zone last week. You can see here it's moving on down. 2 hours, if we take a look at that, it ended up being pretty bearish looking coming into the end of the week. We got that new low. We obviously rallied. We found the sell-off. I think that it's really going to be dictated to more by the inflation numbers, but expect a bit of volatility on the DXY this week. If I had to pick, I guess I'd go with the short end just because it has turned at the key zone, but many trends are still on the bull side there. So the weekly's kind of gone bullish. The daily, etc., is still technically bullish. Let's move over to the gold. Again, that's being trapped. So you can see here the trap between the lows and the highs. This one, I'll pretty much skip over it because I want to see it after the inflation day. Remember, patience, react, don't predict. It's not really worth predicting a range-bound market too much. So I think that's going to be key to think about. Oil, also range-bounding. It looks short on a weekly. It looks pretty short on a daily, but I still think it's range-bound between the 67 and that 74. And everything has to be kind of nimble coming into the inflation figures. I just want to remind everybody, if you're looking for a recession, generally the word recession cannot be really called until we see uninversion of the yield curve. That's generally the 3-month versus the 10-year or the US 2-year versus the 10-year. Until that happens, we usually don't see a actual call of a recession. So I think that's important to note. Now, Tesla was the trade. 251 here on the highs. It got crushed a little bit into the end of the day. It was a pretty volatile stock, not super volatile. You can see volumes really came through. But I just wanted to note here that we've got a candle that then is a bigger candle the next week, which is an extreme candle the next week. Pretty rare sequence of events. When you tend to see these, it means that you're getting near a topping of that particular run. I would be ultra cautious on Tesla calls here. We saw those puts start sneaking in there on the Friday. There was a little bit of disagreement. Remember, every other day had just been like call. Every single day was just 0 DTE calls everywhere. We do have a gap fill that could end up at 264.77, which a lot of people have sent me. I just think it's best to be potentially cautious here. If you've been in it, cool. There's no turn yet, but we're in a massive TD blow off, which means exhaustion is in this market. And this is what happens, at these highs. Again, we've got another potential island reversal where you've seen none activate so far in this particular run up. And I think that's important. If we get a gap down though through the Monday session, it could be a toppers in for now on Tesla. So again, trend is up. 0 DTE is starting to show a little bit of difference. We'll watch it through the week. Apple came back to our 61.8, saw a little bit of sell-off. That's pretty much where we expect it to sell from. Interesting chart. Often I'd like to see sell continue there. If we move over to the DAX, it is boring. It is sitting in the rotation. I don't even know what it's doing. Just chilling in this area. A day trader probably just buying and selling in this little range. It has been making a series of lower highs, which could show weakness, but I don't think it's really worth it. XJO over here, you can see bad looking weekly close. Again, in line with our thought process that demand destruction is probably the trade at the moment for the year. And this is still looking quite weak. I'm looking for 69.50 on the XJO for the Australian viewers. Let's move over to the US 2000. Came off our most traded zone. Tick. Found sells. Tick. A few people in the private community found that sell. Good work for you guys. And it's been pretty okay so far. So that sell was just being patient. It's sold off. We do have a demand range here that it's about to come into. So I think this area in here could be interesting to see where the buyers recommence for the Russell in this zone. So we keep getting that rotation. So I'd probably watch between 18, let's say 1860 and 1850 could be a good level to watch through the Monday trade. We'll come back to you on the Russell. But if you take a look at the weekly, it's still finished bullish and it just rejected that really heavy trade zone. So again, if the Russell had a nice first move, it really, to continue on, it needs to break that high and not get instantly rejected. Qs, they've been in a good run. If they're going to keep running, 370 is going to be the point. I would say that is extreme highs. Everyone will be losing their minds. Calls will be everywhere. I just wanted to just illustrate this. Have a look at the gaps. 1, 2, 3, 4, 5, 6, 7, not that many points away. I don't know if I've seen that many gaps for a very long time. Strange that they've all been left. And then also a lot of those gaps would fill with a mean reversion. So yeah, you can leave some of these behind forever, really, until big calamity or crash happens. But I tell you, it's very strange and very interesting point. Just to illustrate why I don't use indicators too often, here we've got MACD versus an RSI. Now, of course, I know that based on this market structure being a little bit slow and dull on the way it's making these new highs, you're always going to have divergence or divergence between all of these things. Pretty much every indicator you put on the chart is going to show you divergence on this particular time frame. And I think it's just important to note that while I don't hate these indicators, I like them and I think they've got their place, divergence alone is not going to save you from making a short. And remember, it's going to show you that all the time until it doesn't and it breaks out. And I just thought I'd bring that point through. Now, if you have a look here, we have been seeing a dulling market and it's been going up to try to steal the highs. Again, 14,200, I believe, is a critical break process. There's demand all the way through here, and that could instigate swings. And if it instigates swings, then we could be putting the pieces of the puzzle together. So I think that's going to be important. When we move over to the SPX, extreme zone number 2 has been hit. We've got 61.8 of the whole retracement down. There's a lot to like as a bear in this level. But we also even have now our low for rotation. So that's going to be around 42.60. And you can see we use the futures maybe to figure out a little bit better. And we really detailed even last week that there was a great buy last week. And I was hoping that we would see that high getting stolen. And it just couldn't quite do it. It was, that Friday, I really wanted to go higher. Anyway, I almost got the alert, but it didn't quite send it to me. I posted in the private community. I was like, I want that high to be taken, but it just didn't quite happen. We've got markets that sold off a bit into the end of the day. A lot of people ask me what's my opinion on that. Too early to tell. That was, of course, just a trade that some other people took, so that was good. And yeah, I think too early to tell. Some levels to watch on the small timeframes this week. Probably this low here, which is sitting around those lows there. And then, of course, we've got this point here. I think my pricing on the right side's wrong, but yeah, that low there. And then this one underneath here would be the two ones that you can load up. That's a 2-hour chart if you're interested. Let's have a look at the OPEX for this week. We can refresh this now, and this will show us the maximum pain potential levels. And boy, oh boy, are there going to be some very interesting charts this week as we see hedges come off and go on. 3.5 million contracts, 411 max pain, current trading at 430, one of the biggest discrepancies we've seen in a while. If you're looking at that alone, you'd have to say, well, by the end of the week, we should be lower than we are now. I mean, historically, that would be correct. Is it guaranteed? Absolutely not. And you've got to proceed with caution to any of these. But you can see the calls all over the place. 430, very heavy call wall. You've got, of course, 420, 430 basically just being a put calls. And we're seeing that kind of reflex at the moment is every time the dip comes in, BTD or BTFD is the new thing in town. And that means that every time we dip, it's actually getting more calls on it, not less calls. Usually throughout 2023, most of the times we've seen people just add puts everywhere. Well, this time they're adding calls everywhere every time it comes down. Interesting. And I think that shows you that we've got a big switch here that could really be in at these zones. And of course, you've got to proceed with caution. We don't have a sell signal technically on the swings. Let's move over to the Bitcoin and its continuing weakness and pretty much the SEC all over this thing. I still think it's going to 24K. I've said that for a while, pretty much a month or two. It's been a while. So it's been floating on down. And I guess the government is technically helping that trade for me at the moment. How's it going? Well, it hasn't made a new low in the daily close. That would be something that I'd be looking for. And of course, if we have a look at the weekly, this would cement, the weakness as well if it closed down here. Underneath the wicks, first weekly close underneath all these zones, you would think that rally is then met by sell demand as we move towards that 24K. And if you look at Ethereum or some of the others, they're starting to, suffer a little bit as well. You can see here Ethereum trying to make a new low. This has been a very strong coin. Solana, other coins that are in big trouble, they're looking much worse. So the big two, which is all I really like to plot, Bitcoin and Ethereum, both starting to look weak, both about to put in potentially bad weekly closures, which show you that most likely rallies are met by sell demand, at least statistically. Let's move over to the big news. We've got Tuesday CPI numbers, so that's going to be fairly well hedged at the back end of the day. We know that core inflation is always important. Then we have PPI, and we know that that's going to be another big note. Then we've got the FOMC coming out to tell us all about what they're going to do with rates. A whole bunch of central bankers coming through each and every day of this week. We've got core retail sales. It's huge. We've got Bank of Japan. We've got ECB press conference. I mean, it is a wild week for treasuries and a wild week for T-bill issuance. And of course, OPEX as well, the quad witching event. So we've seen the stats. We shared them today. If you enjoyed this content, make sure to subscribe, smash that like button, guys. I hope you enjoyed it. Put a bit of work into this one to get together all this information. It's not that fast to get it all. 3 free trading cheat sheets. And of course, if you're interested, you can follow us on the other socials as well. And do remember as well, the sponsor of today's video for helping out bringing this video to you guys is Tiger Brokers. And if you're from the Australian or New Zealand audience, do remember the special offers down below. A little bit better for you guys. I managed to secure you some of my favorite stock in the market, which is Microsoft. So you get some additionals when you meet the deposit bonuses plus the other T's and C's. Thank you very much. We'll catch you this week for a big week of videos. Make sure to subscribe. Bye for now.